So, good afternoon all. Thank you all for coming to this session. I would like to welcome our panelists here and all the audience. This session is on technology and regulation in payment and credit markets. My name is Rogério Luca. I am currently the head of the Department of Banking Operation and Payment System at Banco Central do Brasil. This department is responsible mainly for the deposits that regulated entities have on the Central Bank of Brazil and for the operation of the payment systems that are operated by the Central Bank, which are the systems that in which these deposits are transferred. Currently we have two systems, an RTGS, which is Sistema de Transferência de Reservas, STR, and a fast payment system, which is the system that settles PIX transactions in Brazil. We are also responsible for the oversight of Brazilian financial market infrastructure when it comes to the settlement of the transactions and the financial risk oversight of the transactions. We also manage the operation of central bank reserve requirement and liquidity facilities. Well, this session covers a subject that covers some subjects that are very close to the heart of Central Bank of Brazil. On the last decades, we have put in place a structural agenda, and we put resources, we allocated resources fostering innovation in the payment and financial services on the market of payments and financial services. The objective has been to raise competition in the marketing, facilitating new entrants, and fostering incumbents to develop new business models and products that can financially include people, proper serve people that were previously underserved by the incumbents, developing appropriate services, lowering costs, and bringing better experience for final users. It's our mandate to ensure the stability and efficiency of the financial system, and we have worked on these last decades through innovation in order to foster this mission. To reach this mandate, Banco Central do Brasil has used different strategies and different instruments that are reflected on the works that we will be discussing on this panel now. We have regulated services like open finance, which is one of the topics we're going to discuss. We have also supervised market organization and market participants, mainly the behavior of the participants, and we're going to discuss here the relation between acquirers and sub-acquirers. And we have also established and operated payment schemes and payment systems such as PIX, which is one other product that will be discussed here on one specific paper. The works discussed here analyze the impact of this action on Brazilian market and focus on final users. I'm honored to moderate this panel and pleased to see the outcome of our work being debated by the Academy on this seminar. So we have three papers now. We're going to start with Matheus. So I'm going to introduce, so if you want to complete or correct me in anything on your introduction later, please be comfortable with that. But Matheus Sampaio, he has a finance PhD. He is a student of finance PhD at Northwestern University Kellogg School of Management. He has a finance bachelor's degree on the University of British Columbia and a finance bachelor's degree on UBC Sauder School of Business. Matheus will present his work on payment technology complementarities and their consequence in the banking sectors, the evidence from Brazil's PIX. So please, Matheus.
Hello, everyone. Where is the slide? Hello, everyone. My name is Matheus Sampaio. I'm honored to be here presenting a joint work with José Renato from the Central Bank on payment technology complementarities and their consequences in the banking sector. The motivation for this paper is that for a long time, payments technologies have been known to bring an array of benefits to the society, right? There's a large body of different literatures that point into this direction of increasing welfare to consumers, especially low-income consumers, when you introduce cheap payment technologies, right? And because of those benefits, we see more than 100 countries all over the world developing new cheap payment technologies. However, very few countries have seen the explosion in adoption as Brazil, right? Opposition to those technologies have been strong in many countries. Adoption has been low, and alternatives to the cheap technologies have been eating the economy with up to 1% of GDP, right? And one example of this is in the United States with the Federal Reserve trying to implement the FedNow, which is a similar technology to PIX, a bank-to-bank transfer. And since the beginning of the project, the banks have been opposed to development of this technology, fearing the competition of fintechs, right? And the Fed, despite opposition, they managed to create this FedNow. In 2023, they were looking to get 8,000 to 9,000 financial institutions, and they went live with only 35. So a basic boycott of the program. And the same thing went for the US digital dollar, with banks lobbying Congress against the creation and development of this technology, and Congressional actually passing this bill to stop the development of CBDC in the US. So this is not exclusive to the US. This happens in many countries, and it's clear why those very powerful players are afraid of technology like PIX, because PIX could substitute very profitable payment methods in the economy, like a credit card that takes several percentage fees, right? It could also decrease the barriers to changing banks, right? So if you create a new digital bank and you don't have branches, it will be very hard without PIX to transfer money to those banks. On the other hand, this is the substitution force, and that's where people are afraid. But on the other hand, PIX could actually complement other payment methods by sharing fixed costs. And what I mean by this is, for example, a credit card and a debit card. You could think of them as being substitutes. But actually, when a firm goes through the trouble of accepting a credit card, they're probably going to accept a debit card as well, right? And once you go through the problem of opening a bank account and setting up a relationship with a bank, and they give you a card, you're probably going to get a debit card and a credit card. PIX could also bring money to banks by increasing the convenience of bank accounts. So if I have a bank account, it is very easy to transfer money. I'll stop using the physical cash, right? And then this change could lead to benefits to all banks, right? And this is the complementary force. So based on these two forces at play, we ask the research questions, right? Are payment technologies substitutes or complements? And how are banks affected by the introduction of new payment technologies? Right? So in this paper, we study PIX. We leverage the information and the data from the central bank. And we use floods as instruments in this case to see the causality of PIX and other payment methods, and how we validate, we kind of increase the validity of our instrument is by studying the effects of floods before and after PIX was created. So our idea is to show you graphically that before PIX was created, floods did not affect our outcomes of interest, right? Floods did not affect the use of payment technologies or the creation of bank accounts or the use of financial services. And after PIX, we see graphically that this happens. So what we see here is the first stage is that the number of PIX users, active users of PIX, grow 4% following a flood. With part of the reason that this happens is because of informal insurance, with remittances growing 3%. And before PIX, we did not see evidence of floods affecting these other payment methods, which is a kind of exclusion restriction that we need to do on an instrumental variable. And then using an instrumental variable and a staggered diff and diff, we see that PIX leads to an increase in the use of boleto, TED, and debit cards. We also find a growth in the active use of bank accounts. So what happens in Brazil, people have multiple bank accounts, but many of those bank accounts don't see any type of transactions of use, and this use now grows. And we also compare traditional banks to digital banks to study the effect whether PIX actually helps those fintechs and destroys traditional banks, and that's not true. What we find is uniformly both are benefited by the implementation of PIX. So the background, I hope you know what PIX is this bank transfer mechanism that central bank created. It's free for people and it's instantaneous. We analyze here the other 4 most popular transfer payments in Brazil, which is a bank wire, which is TED, which is very similar to PIX, except it has some fees. Boleto is a payment slip, very much used by firms to charge for goods and services. And then we have a credit card and debit card. So this is the macro view of what happens in Brazil once PIX was introduced. We did not see the supposed competition effect in which transactions of other payment methods go down. Everything seems to go up, including the value of transactions and the number of transactions, right? So the data for this project is we use floods, which is on the national defense. So they record the effect of floods on municipalities. Bank wire, PIX, and payment slips come from the central bank. We have data on the transaction level of those. Card payments, we have a daily level volume transaction by firms. We have information on banks, when each person and each firm open and close bank accounts. We also have credit relationships people and firms have on each bank. For each person, we have data from the tax authorities, so we get the basic demographics from each person. And for firms, from highs, we can get basic information on firms. So this is the idea, right? Floods are endogenous. Some municipalities are more prone to floods. But whether a municipality A that has the same probability of having a flood as municipality B get affected by a flood is exogenous, right? So what we do is we compare A to B. We control for the risk of being flooded, and then we have a valid control for our diff and diff, right? We control for municipality fixed effects, we control for time fixed effects, and we control for time interactive with flood risks. So right now we are basically comparing the after PIX, which is a period from the PIX creation until the end of 2022, to the before PIX, which is January 19, 2019, to the creation of PIX. And as a robustness check, we also check the period for COVID to see if COVID was the reason we're seeing those results. And then, once I convince you of the kind of validity of our instruments, we use instrumental variables to calculate the impact of growth in PIX into our variables, right? So this is a standard staggered diff and diff. Thank you. And yeah, everything all right with this traditional equation. We don't add any controls, we only add fixed effects. So we control for flood fixed effects. And this is our main result. So this is our first stage result. Here we see people around the flood. In the week of the flood, they stop using PIX because of the destruction of the event. And then after it, it goes up. The same thing goes for firms. Firms, they have a nice flat pre-trend, and then following for a flood, it goes down in the week of the flood, and then it goes up, right? This is the red and the black are sent and received. So basically, around the flood, people start learning how to use PIX. And this is the results for payment methods. I'm showing you here only Boleto and TED, and in black, that's the idea. Black is before PIX. Black is flat around floods. For TED and Boleto, for example. Floods do not seem to affect TED or Boleto before PIX was created. But after PIX was created, we see that floods also don't have an effect, an immediate effect on those technologies. But only after a few weeks and months, we start seeing the transactions of Boleto and TED going up, which is consistent with the idea that, okay, I got hit by a flood, I need to use PIX as a form of payment and a form of informal insurance. I like this technology. Everybody in this municipality starts using this. So we move from one equilibrium to another, and then you start learning about other payment methods. So the whole municipality seems to, over time, get digitalized. And this is the effects on banking. So we don't see anything on the number of bank accounts or the volume, but we see maybe something going on after a few months in the deposits, right? Deposits going up. For the IV, we have a standard IV, also no controls, only fixed effects. And this is the main results as well. So what those numbers mean is that a 1% increase in the active number of PIX users would increase the number of Boleto transactions by around 4%. The same is true for TED, around 4.5% increase in transactions following an increase in transactions of PIX. And this is debit card. We don't see anything for credit card, so I only put the debit card here, of around 1%. For bank accounts, we do not see an increasing number of bank accounts, but I'll show you later the increasing number of use of bank account. So this is some of the other results I have. Self-transfers is defined as a PIX from yourself to yourself. So basically you have 2 bank accounts at least, and then you send money from one bank account to another. What this represents is a type of optimization of use of bank accounts. So if you have a bank account that has a nice credit card, you open that bank account. And then you have another bank account that provides you the best services, and then you have another one. And following floods, we see people and firms actually actively transacting between those bank accounts, showing that people are optimizing their use of bank accounts. Here is a heterogeneous analysis we did, comparing traditional banks and digital banks. So we categorize everything into those 2 categories, and then we see the active number of actively used bank accounts in traditional and digital bank going up basically at the same level. So they are comparable, and it's not true to think that digital banks following PIX are the ones that gain all the customers and the use. You know, traditional banks also see a rise following PIX. And this is one of some of the reason we use floods as an instrument. This is another result on informal insurance. What we see in the literature is that following natural disasters, we see people turning to payment methods as a form of being able to informally insure each other. And we see those results here, right? At the week of the flood, we see a drop. So we divide everything into outflow and inflow, and we see a drop in outflow. So people inside the municipality that was hit by a flood got send less money to other municipalities, and they get money from other municipalities much more. So they are basically receiving donations. They stop sending donations, remittances, and they increase the number of donations they receive. And I have all the results showing the number of people doing this increases, and now actually network effect in other municipalities. So other municipalities, more people adopt PIX because of this, yeah? So in summary, our results show that even after a year, PIX usage by firms and individuals continue to grow, right? So it's not a local short-time shock that people start using PIX and they drop using PIX. So they learn about the technology, they share this technology, and they continue to use more and more. The network effects, we document this network effects on other municipalities, so it's and in firms, right? So people start using PIX, firms start using PIX, people in this municipality start using PIX, people in other municipalities start using more PIX. And we also see an increase in the usage of other payment methods. As we said, increase in boleto, that's the payment slip, TED, the bank wire, and debit card transactions. Individual and firms seem to also better allocate assets between accounts. So that's the self-transfer results. And we see also that bank experience an increase in the active number of users. So to conclude, so when implementing a new technology, we have these two forces at play, right? Substitution and complementarity. So what we have shown is that in the case of PIX, the complementary forces dominate. So we're seeing in the macro level, use of cash going down. At the macro level, the number of physical bills going down. We also see every type of transaction going up. We shown in this paper that the other payment methods became more popular due to PIX, and bank accounts are being more widely used in the population, right? So if I could leave you with something in this presentation is this. So despite the reluctance of those many economies and big players inside those economies to adopt a new technology, our results suggest that the benefits of these technologies, the digitalization of the economy that comes with those very practical technologies, outweigh the costs. So yeah, that's my presentation. Thank you very much.
Well, thank you, Mateus. Just to update some numbers that you show, you said that after a year, PIX was still growing. PIX is almost 3.5 years now, and we're still growing by a pace of 60% a year. So it's still growing even 3.5 years after that. And another anecdotal evidence for what you said, if I'm not wrong, just today, our National Association of Payment Cards have said that credit cards in Brazil have grown on 14% the last year. So other electronic instruments still also grow in Brazil. But to discuss this paper here, we have José Gregorio Aurazo Iglesias. José Aurazo is a visiting economist at the BIS American office in Mexico, coming from Banco Central de Reserva del Peru. He's our colleague from the Central Bank of Peru. He has worked on Central Bank of Peru on payment systems and financial market infrastructure. He has a master in economics of market and organization on Toulouse School of Economics, a master's degree at Economics University del Pacífico, and a bachelor's degree in economics, Universidad Nacional de Trujillo. So please, José Gregorio, 10 minutes.
Thank you. First of all, thanks for inviting me to discuss this very interesting and relevant paper. I really enjoy reading this paper. Before I start with my comments, the views expressed here is on my responsibility and doesn't reflect those of the BIS or the Central Bank of Peru. So this paper, as I said, I really enjoy reading this paper. It's quite relevant because of the success of PIX. As Mateus mentioned, PIX is the most important payment instrument used in Brazil, and other central banks are trying to replicate the success of PIX. So the paper analyzes the effect of PIX on the usage of other digital payment instruments as TED, Boleto, and debit and credit cards. The paper shows that there is a positive externalities of use of PIX on the usage of other payment instruments, in particular TED and Boleto. The author use the staggered diff and diff difference. And the instrument used is floats, which is quite interesting. Before the introduction of PIX, the usage of traditional payment instruments remained unchanged following a float. And with PIX, floats affect it through the channel of informal insurance, that is in-media transfer following a float. So that implies that this instrument is exogenous, as Mateus said. So I will divide my comments in three areas. One is more general, and then I will discuss the econometric strategy, and finally the results. In my general comments is that, well, I would suggest distinguishing between instrument and channel in the terms of payment, because payment technology may confuse the reader. I haven't read about these terms, so maybe to avoid confusing the reader, I would suggest to use payment instrument when you refer to PIX. And also, the more common term used here is fast payment system when you refer to PIX. My first question that I had while I was reading the paper is, what happens to cash? I mean, your paper focuses on cashless payment instruments, but cash is the main instrument used by people in other countries, maybe here as well in Brazil, I'm not sure. So one proxy that you can use is withdrawals from bank accounts. And a couple of comments on your table and figures is that you can also could include the payment channels. I mean, what is the possibility of people using each instrument on-site and online channels? That could be interesting to see. And in figure 1, or an additional panel that you can add is, what is the average value of each payment instrument? I guess that PIX is used for small value tickets, but I'm not sure. So that could be useful and can shed some lights on how and by who are using these payment instruments. So now my comments on the empirical or econometric strategy. My first question is, what is staggered difference and indifference design or method? Because it's not clear in the paper. As far as I know, in a nutshell, a staggered treatment is when interventions vary in timing across units or groups. So here, a better explanation could be very useful for the reader. However, the key assumption here in this design is that once units receive the treatment, they remain treated throughout the observation period. I mean, there is not a reverse. Once I treat it, I remain treated for the whole period. Then another question that I had was, what are the control and treatment groups in your paper? Is not clear. I guess that the control group is municipalities who doesn't register a float, but if you can explain better, that could be very useful. Also, what is the summary, or if you could add a summary of the characteristics of the controls and treatment groups, also would be useful. And here is my main observation or comment. There are nascent literature on traditional diff and diff estimators when the treatment is staggered. Basically, here the idea is that traditional the two-way fixed effects diff and diff estimators is not robust, and maybe could be bias. So I recommend maybe that you can see the literature by Callaway and Santana, Friedman and Goodrich, who propose an extended two-way fixed effects estimator for definitive treatment in a structural manner. And finally, my comments on the results. I have here only 2 comments. The first one is, why are the effects observed in the log term? The paper mentions that this is observed in the weeks 20 and 30 weeks after the flood. So my question is, why in the long term and not in the short term? And the second question is, can the effects observed in the long run be attributed to other development than just the introduction of peaks? For instance, I don't know, fees or any regulation that the government issue? That's my comment, and thank you, and congratulations on your paper. It has been very interesting. Thank you.
Thank you. Can I respond here?
So I think we can open the floor to question, and then you can comment on the final. Is that okay with you? So
yeah, perfect.
We have some questions on the audience here, please.
Hi, congratulations on the paper. I have 2 questions. One is, I'm here.
Yeah, perfect.
Okay.
Find you.
One is, why do you think that TED, or the bank transfer, grows? Or do you think it's the same people, right? Because PIX would be able to do that. And the other one is, if the PIX identifier, the key to PIX,
Okay.
did these people get this key after the flood or before the flood, and then they start using? Because maybe they had it, but they never used it, or because you showed that the bank accounts were there already,
Yes.
right? So maybe it would be interesting to check about the key.
Yeah, let me start responding because I'm going to forget.
Sure,
Yes.
go on.
So
You can comment also on that.
yes, let me comment on your stuff. Yeah. So we don't have data on cash. You mentioned about cash, but we have data on withdrawal. So perfect. We can look at this. So the other thing you mentioned was, yeah, see, I forgot. So why in the long term? You're mentioning, okay, maybe something's going on around several weeks before, several weeks after. So the interesting thing about floods is that it happens all the time. So when I say something happening 3 months after the flood, it couldn't be something stuck in time. So it couldn't be a policy, because that would be the timing of the flood moves. So what my hypothesis is that once people start using PIX, they start learning, and then that takes some time for them to adopt other types of technology. The question you had about TED and why does it go up? So what we can do is to analyze the type of TED transactions, and we can also look at the individual level. So maybe people start using PIX, so firms start using PIX, and then firms be like, okay, I can send a TED to other firms because now I have bank accounts. And TED is actually cheaper than PIX, because for PIX they charge 1% fee, and TED they charge me 10 reais. And I'm doing a large, so it's possible that other types of people are being affected and making the results for TED going up, and we can actually see in the data if that happens or not. And the other thing you mentioned is about the identifier, which is basically the adoption of PIX, or the adoption of bank accounts. We started studying that, and we got no results about adoption. And it was very, very hard to compute the first time for every individual that they make a transaction. So it's like, so we've been struggling. We're going to this direction of adoption, and yeah. So we will be able to answer adoption of bank accounts, the first time they open a bank account or the first time they use Pix. The reason maybe that we don't see anything is that adoption of Pix has been so high that there's very few people that never got or sent a Pix. So sometimes it's just we don't have power, you know.
Okay, I think we have time for one more question there.
My question was very similar to the first one in the audience about the mechanism behind your result, because you're saying that the benefits outweigh the costs, but if you're talking about people are opening bank accounts to use Pix, is different than they already had a bank account and use Pix, especially if we consider between countries like in a developing country where people adopt bank accounts. Not everyone has a bank account, excuse me. And as opposed to a developed country where most of the people have bank accounts. So the benefits and costs might be different in these two settings.
No, for sure. And Brazil is an outlier because we have, people in Brazil have so many bank accounts. Every time you get a new job, that your employer will say, please open a Bradesco bank account. And then you move employer, and then the guy will say, please open a Banco do Brasil, because I work with Banco do Brasil. And then if you want to buy a house, you have to open a Caixa bank account. And if you want a nice credit card, like you get a new bank that is easy to use. So Brazil, what we're seeing is that people have so many bank accounts, they don't open bank accounts because of Pix, right? So maybe in the other countries, this effect will happen, but in Brazil, we don't see any effects of opening bank accounts.
Well, the first effects that you mentioned are pretty much effects of being a formal worker where, you know, you have to open a bank account, place mandated to you. Informal workers might not have that effect. And the last thing that you said, that people have many bank accounts today, like Nubank.
Yeah.
It's probably an effect of digital banks that is something very new, and at the same time probably that Pix started. So those effects might confuse one thing with another, something that you should control for.
No, yeah. One of our robustness checks is to look at the COVID period. So what happens to informal workers is that they all have Caixa bank accounts now because of COVID relief. So before Pix, they all got, like, the whole population basically got a bank account, because the rich people, they already had a bank account, and the poor people got a bank account because of COVID, you know? And yeah, so we look at this robustness checks to see if COVID was the reason that everybody moved to digitalization, you know? And then we don't see anything, yeah.
Okay, we're running a little out of time. I have just one more, so very quick, please.
Okay, so you mentioned the rise of Pix and the rise of Pix users, and also after that, the network effect created by Pix. Have you seen any kind of cost reduction? Because Pix has no costs for users and much lower costs for sellers. Have you seen those kind of post-factum effect?
The post what? I'm sorry?
Have you seen any kind of cost reduction after that network effect of Pix usage?
No, yeah, I didn't calculate any cost reductions. What I've seen is other work that estimate the savings that Pix brought to Brazil in the billions, you know? So it's like because of all Pix transactions being done by Pix, which is free, instead of other payment methods, Brazilians saved billions of dollars, you know?
So, very quick, please.
Yeah, just good, very nice paper. Just wondering whether
perfect. I see.
you've tried you've conceived trying to estimate real effects as well. Okay, making a connection with the literature that studies the nexus between finance and real growth. If you think you have the setting to also study real effects of Pix adoption.
Yeah, I haven't studied, but that's a very good suggestion. Thank you.
Okay, thank you. So just one quick comment you said about opening an account when you get a new job. We have regulated that. We have Conta Salário in Brazil, for example, which to the final user, it doesn't bring any cost to open an additional account in this case. So let's move to José Gregorio now. He's going to present on interchange fees, access pricing, and sub-acquirers in payment markets, please.
So it's me again. Thank you, Rogelio. First, thanks for accepting my paper for this conference. It's an honor to be here. As before, the usual disclaimer applies. In this opportunity, the paper is on interchange fees, access pricing, and sub-acquirers in payment markets. So what is the motivation of the paper? First, as Mateo mentioned, over the last decades, debit, credit, and prepaid cards have substituted cash in retail payments, and recently fast payments also has been replacing cash in this regard. However, there are some persistent problems in fostering cashless payments in developing countries. One of them is the high share of unbanked people. In this regard, fast payment system like PIX could promote the bankarization of people and final users. And also, there is a low merchant card acceptance because many claim that merchant discount rates are high, or simply they don't perceive any real benefit from accepting card payments. In this context, new players, which are payment facilitators or payment aggregators, have emerged offering a new added value product by providing an easier and cheaper way to accepting cards for merchants. These entities, payment facilitators and payment aggregators, are playing a vital role in fostering card acceptance, especially for micro and small businesses in developing countries. So that's the motivation and the whole picture. But what are sub-acquirers or payment facilitators and payment aggregators specifically? Sub-acquirers are fields that enable micro and small merchants to accept multiple card payments like Visa, MasterCard, Amex, Diners. Especially they provide POS terminals. They deposit funds from card payments to merchants. However, they have no direct connection with the card network, like a Visa or MasterCard, but through the acquirer. In that next slides, I will give more details in these relationships, but it's important to mention that here. That implies that sub-acquirers are not members of card networks. As you may know, traditional issuers and acquirers are members of card networks. So for Visa or MasterCard, they already have members. That could be a CaixaBank here in Brazil or another type of bank. In practice, however, there are some small differences between payment aggregators and payment facilitators, but here, for simplicity, in the paper, we are treated both of them as sub-acquirers. This is the whole picture of payment facilitators around the world. As you can see, in the US and Brazil are the countries with the highest level or with the highest number of payment facilitators in the market. In Africa, for instance, there are no sub-acquirers. One thought about that is that because of mobile money is quite spread there is not room for card payments. So how do payment cards work? The traditional scheme is the four-party scheme. Here we have the card network that could be Visa, MasterCard as the most traditional examples. Also, we have the issuer and the acquirer. The issuer has a relationship with a cardholder, and the acquirer has the relationship with a merchant. That could be a micro or a small merchant. When the issuer gives a card to the cardholder, for instance, to me, I have to pay a fee whenever I use my card. But the most common is that I receive some rewards by using my card. So that's why here that the price here is non-positive. And in the case of the merchant side, the merchant usually has to pay a fee to the acquirer. Suppose the following example, we go to a restaurant and we pay 100 reais. Then the merchant will not receive the total amount of that payment, but will receive 100 minus a fee. This fee is known as merchant discount rate. And from that fee, the acquirer will pay something to the issuer. That fee is called interchange fee and is set by the card network. So here we have to have in mind that the key fees are the interchange fee, which is a fee that balances the two sides of the market. I mean, a higher interchange fee promotes the card usage of that instrument, and a lower interchange fee promotes the card acceptance by merchants. Then we have the merchant discount rate, that is the fee that paid by the merchant, and the cardholder price, that is the fee paid by a cardholder or the consumer. So what happens with this model if we introduce a new player? Let's introduce the sub-acquirer. The main difference is on the merchant side. On the merchant side, now that the merchant can contract with the acquirer or with a sub-acquirer. The difference is that now there is a new fee in the market. This fee is the access fee that is labeled by F. So this fee is paid by a sub-acquirer to the acquirer because the sub-acquirer is not a direct member of the card network. So if the sub-acquirer wants to operate in the market, the sub-acquirer needs an access. And who grants this access? The acquirer. So and the sub-acquirer should pay this access fee to the acquirer. The interchange fee is the same as before, is set by the card network, and also there are the merchant discount rates and there are the cardholder prices. So the paper tries to investigate two research questions. One of them is how are interchange fee, cardholder prices, merchant discount rates, and access fee set when sub-acquirers are present or operate in the market. And the second one is, are there any competition issues between sub-acquirers and acquirers? And if so, can the regulator play a role here? So just quickly, literature review on payment cards, for instance, the seminal work by Rochet and Tirol, where they say or mention that payment cards exhibit indirect network externality and are two-side markets. In simple words, there are two sides. One is the consumer side, and the other side is on merchant side. And also, we have interchange fee that balance the two sides of the market. As I said, a higher interchange fee promotes the usage, while a lower interchange fee promotes the acceptance. There are some issues with tax evasion in developing economies. Also, there are operational risks that drives card acceptance exclusion. And access pricing have been commonly discussed in network industry. And finally, it is important to preserve fair access to an essential facility in the digital area. If you can see here, I mean, the paper tries to combine two areas of the microeconomics. One is the access pricing plus two-side markets, which is a characteristic of payment cards. Okay. Well, the model is based on Rochet and Tirol papers on the tourist test, but with a new player that is a sub-acquirer. This model can be extended to the situation of a fast payment system without problem. But let's see what happens in this framework. So my intention is not to go deep in the details of the maths, but is to give the main ideas and insights of the model and of the paper. Here the card network sets the interchange fee that is labeled by AA. As I said before, issuer sets the cardholder prices that could be imagine that they are the rewards. Let's suppose that they have a constant margin. Acquirers set a merchant discount. In the downstream activity, that is that competition for the merchants. And also the acquirers set the access fee in the upstream activity, that is the fee that sub-acquirers have to pay. Sub-acquirers, conditional on entry, will set a merchant discount and then will compete with acquirers for merchants. Then consumers pay by card instead of cash if the benefit of paying by card is higher than the price that they have to pay. And merchants start to accept a card payment also if the benefit of accepting a card payment is higher than the merchant discount that they have to pay to the acquirer. However, here is a common assumption that is called merchant internalization in the literature, and it implies that merchant can extract part of the cardholder benefit. So that idea implies that merchants can accept higher merchant discount, even higher than the payment, the cost payment, the payment cost. So what is the assumption of the model? I am assuming the sub-acquirers are efficient in terms of the benefit that they provide to merchants, and also that they have a lower cost to provide a merchant acceptance. With this in mind, let's see what happens in the downstream activity. Acquirers will set a merchant discount equal to their total cost in the downstream market. That means that the merchant discount rate charged by the acquirer will be equal to the cost. This cost of the acquirers includes the interchange fee. But if they are the sole providers, I mean, they have a markup in the final price. And with that, sub-acquirers will set a merchant discount rate such that the merchant is indifferent between contracting with the acquirer and with the sub-acquirer, and then we will have this final price set by the sub-acquirer. Here the idea is that with this result in the downstream market, then the acquirer will set the access fee. And the main question here is if the acquirer deter or allow entry. So it will allow entry if the profit from granting access is at least equal to the monopoly profit that they have if there is not a competition. So we can say that the entry is probably desirable when this profit, when the acquirer has no incentives to deter entry. So now let's move on the socially and probably optimal fees, particular interchange fee. As I said before, that the main variables here are the merchant discount rate and the interchange fees. So usually in the literature we have three maximization functions. One is the social welfare, that is the total sum of each player. Then we have the total user surplus, that is just the sum of the consumer surplus and retailer profit. And also we have the monopoly platform profit, that is the privately profit here. Here is important to mention that sub-acquirers are not included in this monopoly platform profit because they are not members of that card network, so it doesn't make sense that they will be included. With that, we will have 3 interchange fees. One that maximizes the social welfare, one for the total user surplus, and one for the monopoly card platform. Okay, so the question here is, will the acquirer allow or deter entry? And if so, the government can place a role in that cases? Well, in the paper, I mentioned that when the monopoly profits are higher, then there is a higher incentive to deter entry. Okay, and if that happens, then the government can propose or can set an alternative access regimes. Now, let's see what happens in the context where sub-acquirers compete in niche markets. Niche markets are markets which are not covered by the acquirers when they decide to enter. Until now, we have assumed that acquirers and sub-acquirers compete in the same market, but here, sub-acquirers enter niche markets that are not covered by the acquirer. And the question here is, will the competition issues discussed before remain? Well, the intuition says that now sub-acquirers provide merchant card acceptance where before it was not possible. That means where before cash was the king. Now, society, that means the monopoly platform and final or end user are better off. They use and accept cards instead of cash. So the acquirers have no incentive to deter entry in this market because they obtain extra profits. However, sub-acquirers are entering markets traditionally served by acquirers and vice versa. So here is just that formulas for that situation. We can see that each function has 2 parts. One is the social welfare in the traditional market, and the other one is the social welfare in the niche market. As you can see, the entry of sub-acquirers in markets where before cash was the only payment instrument now is higher because of this entry. So what are the next steps in this paper or in this model? There are 2. One of them is, why would acquirers compete rather than allow efficiency entry? This is basically that Chicago School critic. They say that acquirers will allow efficiency entry as they can extract the efficiency gains through the access fee. So that is true, but there is some literature that tell us that in some situations this doesn't hold. For instance, in dynamic competition or in imperfect rent extraction. The other question or pending question is, what happens if bypass? It means that sub-acquirers can create their own network to access to a card network, for instance, by becoming acquired is possible. That implies that the results discussed before are not robust for this situation. So that is something that I am working on that. So what are the concluding remarks of the paper? Well, first, as I said, sub-acquirers are relevant in fostering card acceptance, in particular for micro and small merchants and in developing economies. When acquirers and sub-acquirers compete in the same downstream market, the former might have incentives to deter entry. In this scenario, the regulator can promote socially desirable entry by setting alternative access charge. For instance, the first best rules, that means that access fee should be equal to the cost. And when sub-acquirers enter niche market, I mean, both society and end users are better off, so there are not incentives to deter entry. However, the role of the regulator should be focused on other aspects, for instance, on quality standards. And it is more common to see acquirers and sub-acquirers competing in the same retail markets, so the access fee will be a relevant variable in the market. So that's all that I have to present. Here is a couple of references, and thank you so much for your attention.
Thank you, Jose. Well, to comment Jose's work, we have here Thiago Cavalcanti. Thiago is professor at the University of Cambridge and the School of Economics on Fundação Getúlio Vargas. He holds a degree in economic science from the Universidade Federal de Pernambuco and a master's degree and a PhD at the University of Illinois.
Right. Thank you so much to be here to comment this paper, also presenting my work. I'm not really an I/O person, so it's going to be really far away from my research agenda. But because of that, I learn a lot reading the paper, right? So, and maybe my comments are going to be off a little bit, but maybe not, okay? So, yeah, so this is, you know, it's an important market. We use, right, all the time, right? So, and I didn't know about all the parts of the market. So it's kind of interesting to understand other parts of the market. So, as Jose was presenting, so there is a massive growth in credit card and that cards relative to cash, right? And usually, if you think about the stores, they are not charging different, you know, prices for that. Okay? So this is basically a transfer, implicit transfer from basically the store to the, you know, to the card, or the card users from the non-card users, right? But of course, the cards are more convenient to use. And this is, you know, you can think about the regulator wanted to kind of intervene in the market because it's highly concentrated, you know, there is, you know, network externality associated with this market, and also, I believe, lots of vertical integration, okay? So it's kind of, you know, the parts, they have market power, so maybe they are going to extract rents, and then the regulators, they have to think about that. Okay? So that's kind of, I think, the big picture of the paper, which I think is a super important question to be studied, right? So if you think about in this market, there are the consumers and the stores or the merchant, how they call, right, in the paper by Rocher and Tihol also. And basically, you have to think also about the acquirer who is going to do really kind of this payment, the intermediation between these two agents, right? So it's going to typically be related to some networks of card networks, and they are going to facilitate the payment, right? So there is, you know, kind of a value added of the acquirer, so it's really not only intermediating that, it's facilitating payment and so on, and so there is a price for that. So here is, you know, kind of, I try to think about, you know, what's going on, you know, and Brazil is our country, right? So I try to think, and I think this is from one study of the Central Bank of Brazil, I think in 2019, about basically the market here, right? So you can think about, say, the acquirers here, right? So this is basically the acquirers, and that's basically the card network, right? And then the issuers of some of these, right? So you can see in Brazil, you know, first of all, most of the cards are basically using different acquirers, right? And then there are lots of vertical integration. You can think about like the greens, all the greens here is really kind of some vertical integration of, say, Itaú with Hipercard, and then which one? The ready, right? And then also the Santander here, and also the blue, some vertical integration. So you can think about here is really, you know, a market that, you know, there are many connections, and also the fact that it's really vertically integrated, right? So the idea here is that merchants, they require multiple contracts with different acquirers, right? And each acquires, you know, all different card brands, and the card brands are connected with some of the acquirers. For instance, in Brazil, until 2010, there was no interoperability on the acquirer side, and then basically VisaNet and Redcard, they held, you know, exclusive agreement with Visa and MasterCard, right? So basically, the merchants or the store, they needed to have, you know, kind of different agreements with the different acquirers and then pay different fees and so on and so on. Okay? In Uruguay, I saw this in a recent paper. They're trying to evaluate this. Is basically the multi-acquiry process just started very recently, right? So in Brazil, it started in 2010. Thanks a lot for the Central Bank of Brazil. But in Uruguay, they are basically starting now in September 2022, right? So it's, you know, kind of really kind of not really a competition in this payment system in Uruguay, right? So this is, you know, from the same paper, what we see here, right? So what we see in terms of HHI, so you can think about this is really kind of very high regulated market here, and has been decreasing in Brazil. Okay. So here's some, you know, in Brazil there was in 2018 something important, which was a cap on the fees that the issuers, they could charge for the acquirers. And then you can see, you know, kind of there was, you know, kind of a change in these interchange fees that are charged by the cards, right, with each acquirers. And also, but not only this, but also a change in the merchant discount rate. Okay, so really kind of a change in the merchant discount rate. Actually, you know, you can think about like the rents has been decreasing in these, right? So I'm not going to kind of repeat basically what's going on in the paper, but I think the two main results are the, you know, kind of these two results here. So the first one is that the acquirer can allow a sub-acquirer that's more efficient than the acquirer to actually enter in the market if, you know, kind of the benefits are highest and the markup, right, of these. But this is not necessarily the socially optimal outcome. The social optimal outcome is when basically the benefits is basically just positive, not only higher than the markup that the acquirers they have when they have the whole market and is not competing with sub-acquirers, right? So this is basically the kind of the main results. And then you can think about these two results that the regulator can increase welfare by setting some, you know, access charge or say some fees or caps in the fees that the acquirers can charge for the merchant, right? So that's basically, you know, kind of the main result. And here's kind of some of my comments. I think for a general audience, it would be nice to have, you know, kind of empirical narratives. I'm not thinking about really kind of any econometric results, but some empirical narrative, you know, kind of motivating the paper, right? And so, I mean, what can we use the model, right? So can we use the model just like theoretically, or can we think about situations also in the markets that you can really kind of look in the data to see, you know, what are the charge, what are the fees, and what can the regulator can do in that markets, right? So look at some particular, let's say, country for instance, in the Uruguay, and see what could be done in Uruguay in that case. Right, and then say connect for that, places where there was some change, like in Brazil, there was the change in regulation to see, for instance, the change in welfare, right? Like in the case of the Central Bank of Uruguay and Central Bank of Brazil, what would be the welfare, kind of implications of that? Like those are my main comments.
Thank you, Thiago. So can you go to two or three questions from the audience and then you reply? Is that okay with you? Okay. So I think we can have some questions from the audience. No, so I think you can start discussing.
So many thanks, Thiago, for your comments. Yes, I totally agree with you. Maybe the papers needs to add some empirical motivation or try to connect these welfare gains of the regulatory changes with what the model is saying. Also, just to add, in your two cases, Peru also implemented a market solution for this change from for this exclusive to non-exclusive relationship between acquirers and card networks. And also there are other countries in that region where interchange fees caps are being in place or set by governments, for instance, in Chile recently or in Costa Rica a couple of years ago. So thank you so much for your comments. They are very useful, and I expect to have a new version of the paper. Thank you.
Questions or comments from the audience? No? Okay, so just two quick comments. You mentioned that sub-acquired generally they are not recognized by the card scheme. In the case of Brazil specifically, we have a rule that we demand that the card network recognize the sub-acquirer as a participant of the scheme. Maybe so one case that you can study more deeply in the future. And the other point I think is that there's a close connection between the subjects of the two works that we have discussed since now. The point is that particularly I think that one of the main reasons of the success of PIX was the regulation that we made before, some 10 years before, on the payment institutions in Brazil. As you mentioned, the sub-acquirer is one kind of payment institution that we have in Brazil, and what we have seen that they were very effectively in terms of bringing people to the market and serve people that, both natural people and merchants, to serve people that were previously unserved or underserved by the incumbents of the financial systems, and also they foster the incumbents to innovate. So nowadays, like I think your paper was very clear on that. You do not see many different nowadays from incumbents to fintechs. You see the app of an incumbent in Brazil is as good as an app of a fintech in Brazil. So I think that we have been successful in these both railways in Brazil, in bringing new people to the market, and for these new people in the market to bring people that were underserved before, and also to foster the incumbents to innovate on the market. So thank you very much. So we're moving now for the last work that we have on this panel. So Thiago now will present consumer loans, heterogeneous interest rate, and inequality. So please, Thiago, 20 minutes.
All right. Okay, so this is my work, consumer loans, heterogeneous interest rate, and inequality. And yeah, so it's like the co-authors, all working very hard. And, I have very little time. So let me try to explain the paper before I present, okay, like in 2 minutes. And so there is, kind of a long tradition in economics, right, to look at, kind of the implications of the credit market or finance for growth, right, innovation, and so on. Right? But also for consumption, right? And consumption is super important for the macroeconomy, for pass-through of economic policies, say fiscal policy, monetary policy. Okay? So what we are trying to understand is really kind of how the credit market shapes consumption behavior, and in Brazil. And how do we do that? We do in two ways. First, we look at really kind of in the empirical part, we look at we document some facts about the credit market, the credit market and consumption in Brazil. And the facts, I think, are super interesting, and, some micro development economists, they had thought about that, this heterogeneity in interest rate that, people, they face, and heterogeneity in interest rate that are not explained by default probabilities. Okay. So, and then after that, after we documented these facts using, kind of very detailed data from the central bank, we thank you to access, kind of this data set, we, through a model, through the lens of the model, we try to look at the implication for consumption, right? So for consumption inequality, for welfare, for consumption is moving, and so on. Okay, so that's basically the paper. Okay, so that's really what we are going to try, what I'm going to try to present here, right? So as I said, kind of there is, some documentation of high and dispersed interest rate in credit market for firms, and that is, kind of a paper that was written before also by myself and the co-authors, looking at the firm level data. So in the firm level data, we see the same kind of pattern. We see heterogeneous, kind of interest rates, and interest rates that are not really kind of explained, at least for the data that we have for kind of default probabilities. Right? And there is not much for consumer loans. Right? So this is, I already said that, so I can jump on this. Right? So what we document here, we first document very large interest rates spreads. Right? That's, I think it's well known for all Brazilians, but maybe for those that are just visiting Brazil, it's not really kind of well known. So it's very large, even for kind of comparing to international comparison with countries with the same kind of level of development. And surprisingly, at least for me, default rates are not very super high relatively, right? So I'm thinking about this as relative, statement, and it varies, with income, okay? So what we are going to do, we are going to basically embed this, kind of embed this credit market, the facts of this credit market into a typical, model of consumption decision, intertemporal consumption decision. And in our model, we are going to have many kind of features that we observe in the, in the market in Brazil. We are going to have informal workers. We are going to have formal workers. We are going to have people working in the public sector. We are going to have retired people, and we are going to have two types of credit that are very common here. We are going to have this payroll credit, which is the consignado in Brazil, which is basically the payments deducted directly from the paycheck, but of course this is going to be access only few workers, they have access to that. And we are also going to have what we call personal loan. Think about, kind of the personal loan in general is, can mimic many things, can mimic the credit card also. But the data that we are going to discipline is not necessarily going to be the credit card. So we embed this in a life cycle model with default, and we basically calculate, kind of the welfare implications, okay, of that, thinking about inequality also. So we see very large welfare loss of these, kind of spreads that you observe, right? So think about like average growth in consumption would increase permanently, if you reduce, kind of this spread by 3.5% of annual consumption. Okay, this, if you think about this, is very large. And this is especially very large for the pool, okay? It's very large for the pool. So this is going to be, kind of an exercise that's not really kind of an exercise that you could think about in reality, because of course there are costs associated with intermediation and so on. But think about this case, what is in the table, right, in terms of what can be, available to actually in some way increase, consumption and welfare in Brazil. Okay? But we are going to discipline one exercise, which is the portability reform. That was done in, basically improved in Brazil in 2013, 2014. And we are going to explore how this portability reform changed interest rates, right? And then basically, kind of see the implications of this portability reform within our model. Okay, so that's basically what I, kind of, and we see, kind of, just, kind of this reform that, basically, a consumer can sell the debt to another bank, basically increase, there are some welfare gains, and really kind of more concentrated on the poor. Okay, so that's basically kind of some of our results. Okay, so I'm going to jump here. Okay, empirical analysis. Right, so this is the credit register data. So this is the loan level data. It's supposed to be the universe of all credit in Brazil, and there are, very rich information, loan size, maturity, loan type, the interest rate, and we see also kind of observe if the loan is non-performing and so on. And then we have some characteristics of individuals, right? So we have some characteristics of individuals like income, gender and other characteristics, but we can also match these with the RISE, which is the matched employer-employee data set, which has the universe of all formal credit. So we can observe employment also, right? So here is, kind of basically the type of consumer loans that we observe in Brazil. Right, so this is personal loans and payroll loans. Basically, those are credit card, installment and revolving, and goods and overdrafts. And we are going to focus on these, which basically 83%. Okay, just because the data set is very large. Okay, so it's not because of kind of we couldn't use the others. Right, we're going to use the two, and I'm going to claim that the personal loan mimics a lot of what we have. It's like the interest rate relative to the payroll loan is very different, right? And is, kind of relatively very close to what you observe in some of this credit card here. So we are mimicking, say, the personal loan, we are basically mimicking the others. Okay. So this is already from our data set that I want to show. So basically, you can see, right, the interest rate here. So that's the average annual interest rate on personal loan and payroll loan, right? So this is, 146 percentage points, right? And 28%. And you can see that this is not very short maturity. So payroll loan is about 5 years. So this is like monthly, in months. So this is about 5 years. And the personal loan is about 2 years. And then that's the default rate, right? So in the default, we are going to say the guy is defaulting, right? So the person is defaulting if it's 3 months late in the payment. And then we are going to say this guy is on the default and is going to default at 100%. Okay, so we are trying to make like the default to explain a lot, kind of what you observe in the data. And the default rate is 6% and 2% for the payroll loan. Okay, so we have this density. So that's how the loan varies, kind of by, just, kind of the loan rate varies in the data. And that's the density. So you can think about the vertical x like the frequency that, some of this loan appears, right, the rate. So you can see, there is very high loan rates and also very dispersed, 50 and more % of dispersion in the interest rate. And you can see, you can do this by income, so up to 2 minimum wage, 3 to 10 minimum wage, more than 10 minimum wage. And you can see that as you get richer, the density is concentrated on more the left, meaning they pay lower rates. Okay, but this can be reflects default also, right? We do the same thing for the payroll. The payroll has less dispersion, but also, you can see that also varies by income. This is the default rate, okay? So, but I'm going to, for the sake of time, I'm going to show this, okay? So this is basically a regression where we try to control for a bunch of things. Okay? So we can try to control, kind of, regression is the loan rate, in the loan, right? So we try to control so there are a bunch of things like the size. We control for size, maturity, age, and age square of the individual. We control, kind of for the concentration of the market, municipality, how the municipality change over time, and so on. But the takeaway here is how the interest rate varies by income. So you can think about the richer individual is the reference point here. You can see that, an agent that has a minimum wage is paying 45 percentage point higher than the interest rate of someone that has more than 20 minimum wage, okay? And this goes down with income, so the slope is negative. And this is, kind of only for the sample of formal sectors worker, right, where we have some measure of financial literacy that's used, kind of in the literature, and, kind of the slope is the same. Okay, so the slope is pretty much the same there. Okay. So this is for personal loan. For payroll loan, the loans rates are much smaller, okay? And then, but you can still observe the same kind of thing, the same dispersion, the same, kind of derivative that you have in terms of how the loan rate varies by income, okay? So this is, kind of what something we explore. We explore this portability to see the effects. And by the portability, so now, people could actually trade, kind of the debt that they had with some of the banks, okay, which was not kind of available before, right? So we can think about, say, municipalities that you have one bank, basically this policy was not very effective. Municipalities with more bank, policy was more kind of effective. So this is what you kind of observe. We observe that, kind of the interest rate in municipalities that you had more than one bank, right? Actually, after that, that's the change in the payroll loan, right? So the payroll loan decreased the interest rate in municipalities with more banks than municipalities with, at least one bank. And this is what we observe for the personal loan. Okay, so you can think about this, this pro-competition reform, given, kind of the market that we had, right? So how it affects the interest rate, okay? So so this is basically the takeaway of the empirical session. The empirical session, the takeaway is the interest rate varies, kind of a lot by income. And something that I was too fast here on this regression here. We are controlling for risk here, right? So this is the controlling for risk. And we are doing this in two ways. We are controlling for risk in terms of, say, ex-ante probability of default that we calculate from the data that we have, right? So we can do that, or we can use basically what the risk assessment of the bank. Okay, so when there is, kind of credit operation, the bank needs to define, what's, the risk of this operation. So we can also control for that. Okay, so everything is in terms of risk is controlled here as far as we can control. Okay, right. So as far as the data allows me to do that. Okay, so that's really kind of the takeaway, right? So the takeaway is that consumers' loans are very high and dispersed in Brazil, super high and very dispersed. Is negative related to income. And this is even after controlling for default, okay, and loan size also, okay. So that's, kind of the takeaway. So here, so of course, different factors can explain such spreads. I'm not saying this is all competition, right? So far from that, I'm agnostic about, so far I've been totally agnostic about that. I just show that one portability reform could change that, okay. So now in my 5 minutes remaining here, I'm trying to, kind of, so let me explain what's really kind of the model, and then, kind of skip the equation, and then I can go to kind of the results. Okay? So this is a standard life cycle model, okay? People are born, so people are born, say, 20 years, and then they have incomes, they can work in different sectors in the economy, they face shocks, right, such that they want to smooth consumption over time, right? And they work until, retirement age, and then they are going to retire, okay? And once they retire, they, kind of, they also face some expensive shocks, right? So they can still need to actually smooth consumption over time. And one way that they can do that is basically accessing the credit market. They can save also, right? So people can save, but they can also access the credit market. Okay? And the credit market is going to be with personal loan, and payroll loan are going to basically be available for a small measure of formal workers. That's what we observe in the data, because the firm needs to have an agreement with the bank to have this deduction. And also, it's going to be available for civil servants and retirees. Okay? So that's kind of the model. Okay? So in the model, something that I want to show is really kind of this equation here. So this is the price of the loan. Think about the discount price of the loan. So in a typical model with default, you don't have this. So the typical model of default is basically, this is the probability of default, right? So this is really kind of expected probability of default, which is endogenous in the model. And that's the interest rate. So you don't have this, what is really what we call a wedge. The wedge would be what we observe in the spreads that cannot be explained by default probabilities, okay? And this is, this wedge is going to be disciplined by our data. It's going to vary with the size of the loan. It's going to vary by income. It's going to vary by the sector that the worker is working, as it is in the data, and it's going to be varying by age also. Okay, so it's going to be varying by a different, kind of characteristics of the worker. Okay, and this is really kind of what we are going to kind of feed in the model to understand, kind of the implications of that. Okay, so there are a bunch of, kind of equations that I want to jump. Okay, and let me go to straight. So we have to discipline. You have to calibrate the model in order to calculate welfare, to see the consumption implication. We need to kind of, set parameters value. And what we do, we set parameters such that we match some features of the Brazilian economy. So the debt-to-income ratio in Brazil, the share of household using debt, default rates by, say, income levels, so by minimum wage here. And then basically, kind of, this is how you discipline the parameters of the model to kind of do the counterfactor exercise. So once we do that, we look at, say, kind of some kind of exercise. The first one is no wedge. The no wedge is a typical model that people write in the consumer default literature, right, using US market, right? So that's the typical model that people they use. You can think about, the spread will be only varying by default probabilities. Okay, the spread would not be varying by any other kind of characteristic, and this is endogenous in our model. Okay, and we look also at minimum wedge, which is Bernardo likes this. At least he liked it when I present the first time in Fundação, which is you can think about the lowest intermediation, the intermediation cost that is needed to do the operation of the loan. So we are going to look at that. And we are also going to look at the portability reform. Okay, so I have 1 minute. So here's, kind of the model. And so the baseline is what we have in the model. And this is the no wedge. Okay, so the no wedge is a very extreme case that you think about. You go to, like, let's say, the US market type of, kind of market. And you see, mean that use increased a lot, right? So mean that use increased a lot. The probability of default decreases a lot, although, there is a composition of people that, maybe more risk getting credit, but in the same time, the cost of the credit decreased so much that default decreased. And this is really the effect on consumption welfare, right? So it's 3.5 increase in consumption, right? And this is another measure that I can talk about this later, okay? And this is, kind of by income deciles, and you can see this is really kind of vary by income. And you can see that the welfare is really concentrated on informal workers that are facing very high shocks in the economy. Okay, so just to close down, we show a lot of the mechanism, but we also do this for the portability reform, which is really kind of now the reform that people can change, kind of, sell the debt. It's not that this, cannot be improved. This probably can be improved even more because basically it was restricted and now there is some, kind of expansion. But, you can see there were fair gains of, kind of a simple reform, just, kind of changing this, right? So this is the paper, right? So documenting facts about, credit market that I think are new, given the data that we use. And then see the implications of, kind of these features for consumption.
Well, thank you, Thiago. Now we have Mateus to discuss Thiago's work. Please, Mateus.
Thank you very much for the opportunity. This paper of Thiago on consumer loans, heterogeneous interest rates, and inequality was a very nice paper, very well written, easy to read, and it was very interesting. So the summary of the paper. So basically, the paper shows this interesting fact about credit markets in developing countries, which are they are not very competitive. So we see this interest rate wedge, right? So they are very high, first of all, and they're very dispersed. So it's actually very, very profitable, what he shows, to lend to low-income people. So we have this profitable market, and it's not very competitive. So they study these two types of loans. Right? One is unsecured personal loans, and the other is the payroll loans. And what they find is that the interest rate wedge is very, very high for low-income individuals in comparison to other people, despite a series of controls. So the same person with the same history, if they are poor, they become kind of like a cash cow to those banks, so they make a lot of profit because they don't default. And they developed this model to basically quantify what will happen if those wedges disappear, right, or they decrease. So increasing the competition would greatly benefit especially those low-income people and informal people, which is very important. They also found that the expansion of the payroll loan would benefit greatly the formal workers. So having this type of credit in the bank, so you see that the personal loan is like 150%, and the payroll loan is only 25. So if we could get people in Brazil into the payroll loan instead of the unsecured personal loan, would bring a lot of benefit. And finally, they quantify the loan portability resolution that was introduced in 2014, and they found that the decrease in interest rate for municipal. So they find this link between higher bank presence and the decrease in interest rate for those people. So it's like the more banks, less profit for banks because of this profitable. People get more competitive, and then they get access to nice loans, better loans. So my comment is that, so this is true in Brazil and in many other countries. So there's a high spread of interest rates for the same person. So what we see in his data is the interest rate people chose to have. But if those same people went to 5 different banks, each bank will give them a very, very different rate. And there's a paper that it wasn't released yet, but it's being developed by my advisor, Sean Higgins, and co-authors, on searching for basically the price of searching in consumer credit markets. So what they're discovering in this paper, which is very, very new, is that the more you search for a loan, the better deal you find. There's a very high reward for searching. So I think he gets it right when he puts the financial literacy control, right? Because income is correlated, so with unobservables. such as financial literacy, which correlates with being able to find a better interest rate. You know, so what I thought about when reading this paper was, okay, maybe this wedge is caused by people searching more. So what I recommend him to put is like this missing control, which you can get from CCS. The central bank has this data on the number of bank accounts people have, and also their banking history. So to supplement the financial literacy control that you have, you can add those things. So if you have 5 bank accounts, okay, maybe you get a better deal, and that's why this happens. And also, I was interested about the income data that you have. So you get this income from the SCR, and I think it's a self-reported income. The other data you have from HIE, so maybe it would be nice to see if the self-reported income matches HIEs, or like there's a way to verify income. Because every time I open an investment account in a bank and they ask me how much money I have or how much, I put a very high amount just so they treat me nicely, you know? So, yeah, the comments on the model, I might be wrong because I'm not an expert, but like in this model, what I see is that the bank knows the individual savings, the income, and the status. So they also calculate the default probability of that person using ex-ante information. So when you put the punishment for defaulting on the model, you didn't account with the possibility, maybe, of that affecting future interest rates on the model. So I'm not sure if I'm correct on this, but it's like maybe there should be a bigger punishment for defaulting. And yeah, that's my commentaries. Thank you.
Thank you. So, Thiago, you want to start, and then we go to the questions, okay?
Sorry. Okay. Thank you, Mateus. So I think the number of banks, the reason we didn't, I think we have the loan level data, and yeah, so I think for some reason when we consolidated the data by individuals, we lost these, you know, kind of, but something that we can go back and it's, yeah, so thank you. I mean, we have to look at this. Yeah, so regarding kind of, I think this is there in the model, right? Because in the model, you know, kind of, you're kind of forward looking, so you're looking all these, you know, kind of, yeah, so I think this is kind of there in the model. And I don't know what was, so it was there, you know, kind of the number of banks, and yeah, so this is, yeah. So we tried okay, so the income, right? So the income and the SCR income and the highs there. So one thing that is in appendix and I didn't show is that we do all the things only with the RISE data, right? So we do all, you know, kind of all the kind of, just because of that, you know, of course, in the highest data, we are not going to have, say, informal workers, but, you know, kind of, we compare these, you know, the results with the highest data only with the SCR, and this, you know, kind of is close to what we have. So I'm kind of, all those self-reported, yeah, so that's what we have, but it still, you know, kind of correlates well with RISE.
Okay, thank you. Questions and comments from the audience, please.
Hi, Thiago. When I hear macroeconomists talk about why interest rates are so high in Brazil for consumer loans, we get the sense that they always say is the high delinquency rate, and it is the market power of certain banks. But you show that market power is part of the answer because earnings are negatively correlated to interest rates, controlling for a lot of things, including risk assessment and default ex ante probability. And the risk assessment probably contains the punishment if you defaulted before, right? So what other stories could there be to explain this correlation that is negative if you control for a default and if market power is only a part of the explanation? Mateus mentioned probably financial literacy, that could be a part, but what else could there be to drive a policy that could decrease these interest rates? Thank you.
Thank you, Paula. Right, so first of all, I mean, we are super agnostic about, kind of what's driving that, right? So even in the model, we are agnostic. There is a wedge there, right? And we are not saying the wedge is really kind of market power. The wedge can be, intermediation costs, it's harder to monitor and to kind of screen, different types of workers. So it can be driven by that. But of course, can also be driven by, market power, right? So in terms of both the empirical and kind of our empirical analysis and also kind of our quantitative exercise, if we use kind of the language that we use in macro, we are kind of agnostic. It's only when we discipline the model by the portability and the change in the portability that we are saying, look, this is what we observed after this change, and this generates such and such percentage change in municipalities with more presence of banks relative to less presence of banks, right? And that we can use to see the implications in the data, right? So financial literacy, we control for that by using, kind of the standard measure that people use, using if people, they have, say, work with numbers and, schooling, and if they work with numbers, because we can see this by occupation in the RISE data, so we use only the RISE, so we kind of control for financial literacy. And, kind of, financial literacy is important. It's not that it's not important. It's not important it doesn't, basically break down the relationship that we have in income. It's still, statistically, different from zero, and it's important to explain spreads, but it's not like sufficient to kind of, break down this slope that we observe in the data.
Hi, Thiago. So I have two comments and a question. So the first one would be if the results hold when you're just looking at payroll loans instead of the other types of unsecured loans. And also, two issues. The first one is that just if you consider that the payroll loans for the retirees care for the whole family, right? So the other informal workers, or even if you are a formal worker but you don't get the paycheck from the state, which is the case of the retirees, then it's hard to get a payroll loan. And so when you're lending to a retiree, you may be lending to the whole family, right? So that is one thing. Now, what I was thinking about is, I didn't read the paper, but from your explanation, it looks like there is the portability would be a decision or the borrower searching for a new lender. And what I hear from anecdotes is that in case of payroll loans, it's actually a supply story. So it's the banks that are calling borrowers from other banks and say, hey, I can offer you a much better rate, right? So I think that would affect the story with the financial literacy, maybe, I don't know. But I think it's something that's interesting to mention. Probably in the case of real estate credit, it may be very different. That then it would be a search So a demand to change the lender instead of the lender calling you in the case of the payroll loans?
Thank you. Very good questions. So for sure there are lots of arbitrage, and we cannot capture in the data, like meaning, some family member is going to, is going to marry, and then you take the loan to, kind of, just because it's a cheaper way to, for sure, I'm sure there are lots of arbitrage, but in the data we cannot capture. We see the same kind of, because the payroll loan interest rate is like on average 4 times lower than what you observe for the personal loan. So the effect is not as dramatic, but you still see this changed way of income. And it's kind of a little bit saying, look, why a retiree that's 5, minimum wage, has this income by the same age, kind of worked in the same, kind of occupation, why, maybe, the probability of dying is higher. I don't know. I mean, so it can be that, but this is still you're observing that the interest rate varies negatively, right? So that's basically, kind of, we still observe that certainly there are lots of arbitrage. Regarding kind of the supply and the demand, we cannot say, I mean, in the model, we are, again, we are not really, it's just, kind of before the portability reform, there was no possibility of selling the debt. Now there is the possibility under some condition to sell the debt, right? So that's basically an equilibrium outcome that we are observing in the data and also in the model, right? So in the model, we are kind of not really modeling, basically the supply and demand. We are just kind of modeling the possibility that this can happen.
Thank you.
Very good question related to the first one, actually. So I get that these wedges, you remain agnostic about them, but default rates are endogenous, right? So maybe if part of these wedges are determining delinquency rates, it can change the interpretation of your results. For example, operational costs. For the very low-income workers, usually banks guarantee repayment on time through ex-post monitoring, right? Like in-person interactions. So that generates an additional cost that can explain partially these high interest rates. And if you remove wedges, you are basically affecting the delinquency as well. So that can change the interpretation of the results. And I'm particularly interested on that because of your table of income heterogeneity. I think that in that table you can also have product heterogeneity, right? Because if you're a very low income worker, probably you are asking for very small size loans that have higher average costs, right? So can you control for the size of the loan, for example?
So the size of the loan is controlled in our regression because this is so important in the literature, right? So since Banerjee, this is so important, and the size of the loan is controlling that. And in the model is also, the wedge varies by size, of the loan, varies by sector that the person works, vary by the income that the worker, and by age. So, and this is really kind of what's coming from, the micro level data. That's what you feed in the model, right?
About the treatment measure, if I understood correctly, you have a discrete treatment, but, there is also a continuum treatment, possible treatment that is related to competition in the local market, like HH index or the share of the
That's true. That's true. I mean, we do control. I mean, this is just. There is another paper that I think was presented last year, really kind of a policy evaluation on the. I didn't come. It was Amanda who came, and she presented this policy evaluation of this portability reform, right? And then we do kind of all the kind of robustness and, kind of different specification, including, controlling for HHI or by HHI, right? So we do kind of a very different specification. And, in general, that's kind of the result is basically the portability is more important when you have more competition, local competition in the market, or less concentration in the market, right? Yeah.
Just wondering whether in your theoretical model you are able to decompose these welfare costs into what is driven by the dispersion and by the level of the interest rates, the high level of the loan spreads. Because I suspect that although you say that you control for PDs to the best you can, but we at the central bank know that data is lacking on a very good control for PDs. So if the wedges, if there's no differentiation by income, or in other words, if the wedge is uniform across all income categories, it doesn't remove the fact that the spreads are still very high and
right.
Introduces costs.
No, this is a very good question. I mean, we do that in one of the exercise, which was try to explain, but it was just because the paper is now 80 pages, and I have to present here in 20 minutes. So, but we do one exercise where, we observe, say, the minimal wedge, okay? And then we say, suppose that, this is really kind of the cost of intermediation, of monitoring, and the rest are things that could be changed, okay? And then we change this, we leave this for everyone, okay? We leave this for everyone. And then so everyone is now facing the same, kind of spread, right? So, of course, there is the endogenous part of the spread that's still there, which is the default probability, because the model is capturing that, right? So this is still there. But now let's suppose that everyone is facing the same kind of wedge. So we do this exercise, and it's pretty large because since the pool received more and the pool has a higher marginal utility of consumption, right? So those are that really kind of hit that. So the kind of main takeaway of the quantitative exercise is still there.
Thank you. So we're closing the day. Thanks for our panelists here. Congratulations for your work. For me specifically, it was a great pleasure to take part at this panel as the moderator. As I mentioned before, I think it covers the subject of the three works covers subjects that are very close to the central bank work. And for us, it's very good to see the discussion of the work that we have done, and very grateful also to see the good results of what we have done. So thank you very much. Congratulations for your work. This is the last panel of today. We're coming back tomorrow at 9 a.m., right? So good night to everyone. Thank you very much.